Wall Street is about to be banned from buying more homes. No more cash offers swooping in before you even finish your coffee. No more losing your dream kitchen to a hedge fund that's never even set foot in it. Finally, you're not competing with Wall Street to buy a home. Or are you? Hey, stick around because I'm going to walk you through every way they can still get around this ban. And it's not the loophole you're thinking of. It's not a new LLC. It's not a fresh trust. It's a sentence buried in the bill itself, and I want to show it to you before the video's over. Here's the thing. You've heard the other take already. You've heard it in the comments under every article about a family losing a bidding war to an all-cash offer. You've heard it as a caption under every viral post about a whole cul-de-sac getting bought out by one investment fund. If we could just get corporations out of the housing market, prices would come down and regular people could actually buy homes again. That sentiment isn't new, and it isn't paranoid either. Watch this. The Government Accountability Office itself estimates institutional investors own roughly a quarter of the single-family rental market in Atlanta. Not some blog, the GAO. When 1 in every 4 rental houses in a metro belongs to a handful of investment funds, just ban them doesn't sound extreme. It kind of sounds like common sense. So, on July 11th, 2026, Congress basically said, fine, we hear you. But rewind the clock, because this didn't start in the halls of Congress. On January 20th, 2026, President Trump signed an executive order, 14376, stopping Wall Street from competing with Main Street home buyers. Now, a president can't write a law with an executive order. What that order did was direct the Treasury Department to go build the actual definitions. What counts as a large institutional investor? What counts as a single-family home? The exact building blocks Congress bolted into this bill more than a year later. So, when you wonder why the definitions in this law are as specific and locked down as they are, that is why. They didn't start as a rushed floor amendment. They started as a year-long assignment handed straight to Treasury. Here's what actually happened next. The federal government did something it has never done in American history. It put a hard number on how many houses a corporation is allowed to own. Cross it, and you're not looking at a fine. You're looking at a penalty of $1 million or 3 times what you paid for the house. Whichever number is bigger. That is the 21st Century Road to Housing Act. And here's what I think actually matters, not what the headlines led with, because the headlines got the easy 20% right, and they just stopped there. Here's the math that makes this work. The law targets what it calls large institutional investors, any for-profit entity that controls 350 or more single-family homes nationwide. Not per city, nationwide. Cross that line and you can't buy another one. Not directly, not through a shell. Investment control is defined broadly on purpose. Anyone who owns 25% or more of the equity in the entity that holds title counts. Anyone running the fund counts. Anyone with primary decision-making authority counts. Purely passive money, somebody who just wrote a check and has no say at all, that's the one carve-out. Break the rule and the Treasury Department, not HUD, comes after you. Civil penalty up to $1 million per violation or 3 times the purchase price, whichever is greater. That is not a cost of doing business. That is a company-ending number if you scale that across a portfolio. And let's put names on this. We're talking about companies you've probably already heard of. Invitation Homes, American Homes for Rent, Progress Residential. Between them, that's hundreds of thousands of single-family homes across the country. Those are exactly the kind of companies this bill has in its sights. And yes, I know exactly what name you're waiting for, Blackstone. Here's where I have to correct something a lot of people believe. Blackstone does not own 1 million homes, not even close. Outside tracking puts Blackstone's single-family rental holdings at around 63,000 homes. That's a tiny sliver of a percentage of all the single-family homes in the country. It's also not the same company as Invitation Homes anymore. Blackstone sold off its entire stake in that company back in 2019. What Blackstone actually holds today mostly runs through a company called Tricon Residential, which it bought back in 2024. So, Blackstone is real, and 63,000 homes is nothing to shrug off. But the number the internet keeps repeating is just wrong. And I'd rather tell you now than let you catch me wrong later. And before you type it, yes, I already know what a lot of you are thinking. Why didn't they just force these companies to sell everything off, even if it took 10 or 15 years to do it gently? Even the toughest version of this bill that ever existed in Congress, the Senate's original draft, only proposed forcing a sell-off of newly built rental communities after 7 years, not the whole existing portfolio, just new construction. The House even killed that. A full mandatory wind down of every home an institutional investor already owns, gentle phase-in or not, was never something either party's negotiations were going to survive politically. This bill passed the Senate 85-5 and the House 358-32. Numbers like that don't happen by accident. They happen because both sides gave something up. The trade was no retroactive clawback of property that was legally purchased in exchange for actually landing on a hard line on future purchases. You can think that's the wrong trade, but it wasn't skipped by accident. And it wasn't Wall Street buying its way out of it either. It's the reason this bill has teeth going forward instead of dying in a committee like every other version before it. Here's what I know for certain, and what I don't. The core ban is solid. That 350 home threshold, that penalty, no wiggle room in how it's written. What's carved out is also solid. It's sitting right there in the statute, not a rumor. What I don't know yet, and what nobody does, is how corporations actually behave once this thing goes live, and whether it moves affordability at all. That's exactly the kind of thing worth watching instead of just guessing at it. Quick gut check before we go any further. Drop a comment right now. Do you think this actually gets you a house, or is it too little, too late? I want to see where you land before I complicate it. Because here's the complication. Two things can be true at the same time. This is real, the first federal statute in American history putting a hard ceiling on corporate single-family ownership. And it does almost nothing today. The ban doesn't take effect until 180 days after enactment. That's roughly January 2027. And right now, this week, a hedge fund can still buy the house next door to you. The law is loaded, but it isn't firing yet. Mark that date, because that is the runway that matters. My bet, and it is a bet, not something that I can prove, it's the company that owns 40,000 houses doesn't just sit around once it knows the buying window has a closing date. My guess is that they accelerate. That's the thing I'll be watching for between now and January. Not something I can tell you is already happening. Now, let's get into what your average viewer isn't hearing about. This bill is not a wall. It's a wall with 11 marked doors in it, plus one more sitting completely outside the list, which is the one that I talked about at the top of the video. Door number 1, new construction built for sale, not for rent. If a builder puts a house up intending to sell it, that's not a purchase ban violation because the investor is the seller here, not the buyer. Door number 2, build to rent. This is the big one. The Senate originally wanted to force any institutional investor to sell off build-to-rent communities within 7 years. The House stripped that out. Purpose-built rental communities are fully exempt, permanently. And here's a two things can be true moment worth sitting with. Keeping build-to-rent alive does keep rental supply flowing, and more flowing supply generally means more competition among landlords, which should put downward pressure on rents. That part's straightforward. But the same class of investor building those communities is also the one facing separate scrutiny. The Justice Department and multiple states' attorneys general have brought antitrust litigation over algorithmic rent pricing software, alleging it functions closer to coordinated price setting than independent competition. So, more supply from the same group is real. Whether that supply actually translates into lower rents once you're a tenant is a live, unresolved fight, not something that supply math alone can settle. Door number 3, Renovate-to-Rent, but only if the investor sinks at least 15% of the purchase price into fixing a home that's failing local building code. That's not a small ask. That is real rehab money, not just paint and countertops. Doors 4 and 5, 2 flavors of the same lease option rent-to-own programs, both requiring a 30-day first look window where the renter gets first crack at buying before anyone else does. Door number 6, satisfying a debt that was already owed to the investor. Repossession rights on a contract they already held. That makes sense. Door number 7, foreclosures, deeds in lieu, and loan servicing. If a lender ends up owning a house because a borrower defaulted, that's not what this law is trying to stop. Door number 8, buying from another large institutional investor, as long as that seller already owned the house before the law existed, or bought it playing by these same rules. This is the recirculation door, the same pre-enactment homes we already talked about, the ones the law never forces anyone to sell, can keep trading hands between institutional investors indefinitely without ever touching the open market. What it can't do is let a company add new homes beyond what the other exemptions already allow. It reshuffles what's already there. It doesn't allow the pile to grow. Door 9, buying from a smaller investor who isn't covered by this law at all, but only within a 2-year window after the ban kicks in. That door closes for good around 2029. Door 10, 55 and over age-restricted communities. This is the one that doesn't fully add up for me. For new construction, I get it. Active adult build-to-rent is a real growing category. I've seen major developers building whole communities marketed straight at baby boomers who want to downsize and rent instead of own. That mirrors the same new supply not competing with a buyer logic as door number 2. That's fine. But this carve-out also covers renovated homes and rental conversions. And unlike door number 3's renovate-to-rent path, there is no 15% rehab minimum attached here. No skin in the game requirement at all. To be fair, this isn't a case of an investor buying any random house on a random street and slapping 55 plus labels on it. Under the broader federal fair housing framework, age-restricted housing generally has to operate as a genuine 55 plus community with real occupancy rules to legally qualify. This bill doesn't spell that requirement out itself in this section. It just leans on the existing framework without defining community fresh. But inside an existing age-restricted community, an investor can still buy up older housing stock, do a light renovation, and bring it into that community's rental pool without anything close to the rehab commitment door number 3 demands everywhere else. For a state that's home to the largest age-restricted communities in the country, that's not a small detail. I genuinely don't understand why the renovation pathway got a pass on the rehab minimum here when it didn't anywhere else. Door 11, loss mitigation and court-ordered transfers. If an investor acquires a property to settle a default, bankruptcy proceeding, or pre-existing legal contract, that's exempted too. That's not a purchase exemption. That's a corporate shuffle exemption. Sit with that one for a second, because it quietly does more than any of the other 11 doors combined. It's not about buying new homes. It's a guarantee that nothing already owned ever has to come back on the market at all. One more thing, and it's not even on this list. Manufactured homes aren't covered in any of this. Not door number 1 through 12. None of it. They're written out of the definition of single-family home before you even get to the exemptions. And in the same bill, a different section makes it easier than ever for a manufactured home to legally qualify as one. Put a pin in that. It's a whole video by itself. If you've already got "just start a new LLC" half typed into that comment box, hold on to that thought. And here's who's actually watching for it. Not HUD, not some new housing bureaucracy. The Treasury Department, the same agency holding that $1 million penalty. Treasury's allowed to write regulations to close evasion tricks as they show up. But Congress boxed them in on purpose. They can't loosen the 350 home threshold, can't narrow what counts as investment control, can't quietly add exceptions to the 11 we just went through. That's not an oversight. That's Congress trying to stop a future administration, either party, from gutting this thing through the back door of rulemaking. Which is also exactly why splitting homes across 10 new shells doesn't get you under the 350 if the same people still hold 25% of each or still call the shots. I've got a video coming where I break down exactly why that trick doesn't work the way everyone thinks. So keep that thought and we'll use it later. If this kind of straight through breakdown is what you've been looking for, hit the subscribe to follow us. Now, back to that GAO number from the top, the 25% in Atlanta. Here's the part that number doesn't tell you. Real estate data firm Parsi Labs found large-scale investors own roughly 1 in 7 single-family homes in some specific pockets of Atlanta. But zoom out to the whole city, and their total share of all single-family housing stock is only around 4%. Redfin's own chief economist said publicly that the reason first-time buyers are struggling isn't primarily large investors. It's that homeownership has gotten unaffordable across the board. A real estate finance professor at William & Mary told CNN this law helps at the margin in specific neighborhoods, but doesn't touch mortgage rates, limited inventory, zoning, or construction costs. So here's my read, not gospel. That 25% number is real. It answers a real question. How much of the rental market in a handful of concentrated metros is corporate owned? It just isn't the same question as, will this fix housing affordability? And a lot of the internet has been treating those two questions as the same thing. Where does Florida land in this? A 2024 GAO estimate put institutional investors at 21% of Jacksonville's single-family rental market and 15% of Tampa's. Separately, investors with 1,000+ homes concentrate 45% of everything they own into just 6 metros nationwide: Atlanta, Phoenix, Dallas, Charlotte, Houston, and Tampa. Tampa is on both lists. My bet is this law bites harder along the I-4 corridor than almost anywhere in the state. But here's your second two things can be true moment. Investor purchase activity was already falling in parts of Florida before this law was even signed. Down 18% year over year in Orlando, 14% in Miami, 14% in Fort Lauderdale, according to Redfin. That's not federal policy. That's rising HOA fees, surging insurance costs, and home prices that had already softened enough to scare off the profit. In some corners of this state, Wall Street is quietly packing up before Washington even got involved. Here's the takeaway, and it's mine, not a verdict handed down from Washington. The ban itself is real and it's solid. A hard threshold, a penalty with teeth, 12 ways around the edges written directly into the law. What I can't tell you is whether it actually moves the needle on affordability, and I'm not going to pretend otherwise just to give you a tidy ending. I put together a plain English breakdown of the whole bill. The ban, all 12 doors, the effective date, everything. Free. Link is down below. Grab it before the next video drops. And I know some of you are thinking that quiet part out loud instead of typing it. You don't actually want to fix. You want to crash, because that's what really gets you a house at the price you can afford. Fair enough. Say it in the comments if that's you. Just answer me this. Would you still feel that way if the crash wiped out your own equity right along with everyone else's? Hey, this has been the Florida Real Estate Insider. I'm still Tom McNamara. See you in the next one.